ask anybody in India as to which asset class is a part of your portfolio and has given you stable returns, and the answer would be gold. Over the last 15 years, 10 years, 5 years or more, the returns that have come in from the precious metal have been steady if you look at it on a CAGR basis or an annualized basis, never mind what happens in a particular set of years. The question is, from where we are right now, with gold having, or the precious metals at large having done what they have done, from an investment perspective, could there be more in store? And more importantly, what are the factors that one should keep in mind when thinking about whether an investment or consumption in gold at the current prices for the next 1 year, 3 years, 5 years, or longer? We have a very special guest with us to talk about that, John Reade, of World Gold Council, joins in right now to speak about his thoughts. Great having you. Thank you so much for taking the time out. And it's so much in vogue right now, gold. What are your thoughts about this kind of attention that it is getting? Is it, I mean, I'm guessing multitude of factors, including investment demand because of what ETFs have done, or this whole belief that inflation could rear its way back and therefore that, or just a safety haven vehicle?
Yeah, there's certainly lots of factors that are driving the interest in gold at the moment. I think the main one is a recognition from investors that we're in for a very rocky time for the global economy. The impact of the coronavirus has taken global economic activity or growth to its lowest levels that we've seen likely since the Great Depression in the 30s. So investors are turning to gold as a way to diversify their portfolios and potentially protect them from volatility in other asset classes going forward.
Now, this has always been the case, right, John, all through. I mean, whenever we've seen big spikes, it's accompanied by uncertain period. My question is, we kind of hit this bout of uncertainty for investing classes well before COVID-19 hit us. In 2019, if it was the trade talks that used to hurt and some conversation about tapering down, then COVID-19 has happened and we do not know what happens ahead. So what's your sense of the kind of rush that we're seeing? Because frankly, the data I think that you guys have put out, which shows how gold-backed ETFs have recorded 7 consecutive monthly increase, total inflows exceeding records of previous years as well. What's leading to this craze?
Well, there's a couple of factors there. And you're right to say that this wasn't just COVID-19 that has driven the interest in gold. We certainly saw interest in gold picking up for about 12 months ago, really. And I think that was an expectation that we would see the Federal Reserve having to cut rates. If you think about the economic recovery that we had from the global financial crisis, it had been accompanied by low interest rates and certainly early on, a lot of quantitative easing and other extraordinary stimulus. As the Fed tried to take back some of that stimulus and to begin to hike interest rates, it very quickly became clear that financial markets and perhaps the broader economy weren't well positioned to accommodate tighter monetary policy. So at that stage, I think the markets realized that we were likely to be in a situation which would be beneficial for gold, and we saw decent-sized investment in it. Now, you're right to look at the ETF flows because they are important, but there's some other factors that have been taking place that perhaps have magnified the inflows into ETFs, particularly since March. Traditionally, a lot of investors and speculators would have bought gold via the futures market in New York called the COMEX futures market. Because of the dislocation that's taken place between the COMEX futures market and the London over-the-counter market, COMEX is not as efficient a way for investors to take positions in gold. So I believe that there's been some diversion of investor interest away from the futures market towards the ETFs, particularly those listed in North America. So don't get me wrong, it's really positive that we're seeing these ETF inflows, but they may not be quite as big as they first appear.
Interesting. So, okay, just a follow-up before I get to the other bit as well. Does this unravel at some point of time when normalcy returns to the market?
I think you could see that. If you look previously, after the global financial crisis, again, similarly, large investment positions were built up in gold. And then we got to a stage where the economic recovery was well entrenched, and some of the fears that you mentioned before regarding inflation, etc., dissipated, and we saw quite a lot of profit taking coming through in gold. So look, that's always going to be a potential, particularly when you've seen such a rapid increase in investor positions. That can reverse, but it shouldn't get in the way of the long-term arguments for owning gold. We argue a lot that it makes sense for pretty much every portfolio to have some exposure to gold pretty much all the time. Now, that exposure can be increased or decreased depending on the circumstances, and maybe that's what's been happening at the moment, is that people have been increasing their weightings towards gold globally because of what's happening in the global economy. And as I say, that could be decreased under certain circumstances when we come out of the end of this, I wouldn't call it financial crisis yet because it isn't one, but certainly economic crisis that has been kicked off by COVID. Maybe a couple of years down the line, we will see profit taking. But it is extraordinarily difficult to make predictions at the moment, simply because we don't know how the virus is going to play out, and we don't know what the impact is going to be on the global economy.
In your assessment, John, and all through the history that you may have seen, do you reckon that gold prices at times tend to be directly proportional to the size of the Fed balance sheet and the other balance sheets expanding because there is easy money, it flows to all asset classes, and this time around because debt instruments don't give you returns, you do equities, gold, maybe Bitcoin, and all of those flourish. Is that a legitimate argument?
I certainly think that the economic circumstances which justify a rapid increase in central bank balance sheets plays a role in increasing the interest in gold. I wouldn't call it directly proportional. I would say it's certainly related. In terms of the fixed income arguments you make, those are very important. And we're having conversations with a number of very large institutional investors with fixed income portfolios, particularly those in Europe, who are faced with the prospect of buying negative nominal yielding bonds in European government debt, and looking at that choice, in other words, locking in a loss by buying those negative yielding instruments. Some of them are putting some of the inflows that they're getting into gold rather than into fixed income. And I can certainly see the case. I mean, there's no doubt that opportunity cost, in other words, interest rates, is a big driver of the gold price. And now that we're in negative territory in real terms for most bonds and nominal terms for some bonds, that's playing a role in the increased interest we're seeing in gold.
But that may not die away in a hurry, right, John? I mean, we might well see, I mean, unless this whole spoken about inflation comes back, and if it does, right, we don't know when it would, because for the last so many years, we haven't seen inflation rear its head. So if that doesn't happen, would you reckon that, and if indeed the bond yields stay low or fixed income returns stay low, would you believe there will be a natural propensity towards other asset classes, including gold?
I think that's absolutely right. I think that I don't see any signs of central banks wanting to, or certainly being able to, increase interest rates. I think bond yields are going to stay low in nominal terms for a very long time. And even if inflation doesn't pick up, I think that low opportunity cost of holding gold is going to be a big factor in driving investment into gold, arguably investment into stocks, and potentially even into things like Bitcoin as well. So gold's going to benefit. It probably won't be the only thing that benefits. As to inflation, I think the biggest risk at the moment is that we're in a deflationary environment for the next year or two. But I'm beginning to see, again, some smarter investors, some smarter commentators in financial publications talking about the potential for inflation in the medium to longer term. And in that case, we're likely to see real interest rates declining even further. And real interest rates are a very strong driver of the gold price. So look, it's very difficult to map out what's going to happen with the global economy and to predict what's going to happen with asset prices. I certainly wouldn't have expected such a rapid rally in US equities, for example. But I think it is safe to say that bond yields are going to remain subdued, and that there is the potential after a period of deflation for people to become more concerned about inflation, perhaps a year or two out.
Okay. One more follow-up to that. I mean, we speak about this rush in gold prices. It's probably not accompanied by as strong a consumer demand as you would have otherwise seen in the past years. Am I right, John? Because at least in India, for example, there are numerous examples of how, because of the lockdown and the economic crises, people are not buying as much gold as they otherwise would.
No, that's absolutely right. This is a period of gold price strength that is being driven by investment, consumer demand, not only in India, but in other major markets around the world, is very much taking a back seat. Now, obviously, we've had economies which have been locked down and effectively jewelry shops closed, an inability to move gold around, so imports into India have been very low. So there's a direct impact of the coronavirus, but obviously there's an indirect impact as well. So people have less money to spend. They have seen their wealth diminished. They may have lost their jobs. So around the world, we're not seeing strong consumer demand. Although I expect it to improve sequentially from the third quarter of this year, even if we get a V-shaped recovery in global economic activity, we're not going to see 2020 as a strong year for consumer demand. Now, investor demand so far has been strong enough to lift the gold price. That typically does happen. Investment demand can buy more when consumer demand steps back. But really, the outlook for gold over the next couple of years will be determined by the strength of investment demand. We could get to a situation with recovering consumer demand as well as strong investor demand, and that could be a very positive combination for gold. But it's going to take a while for consumer demand to come back to the same sort of levels that we've seen, say, in 2018 and 2019.
One final question, and I'm not saying that the World Gold Council would be in the business of making predictions, but I'm just asking for your gut, John, because from a lot of people who are watching this video as well, the broadcast as well, a lot of them might be confused that if there are so many factors which are, I mean, there's no consumer demand, so on and so forth, and the rally has been so strong, tactically or from a 3-5 year perspective, are there fundamental factors in place for gold prices and prices of precious metals to move up even higher? What's your sense?
We're not in the forecasting business in terms of price, but what we do have is we've developed an econometric model, which is available on our website, which allows you to put in your expectations of economic growth, interest rates, etc. Now, this Quorum valuation tool on our website, using some external forecasts of what's likely to happen with the economy, looking at a V-shaped recovery, an L-shaped recovery, a U-shaped recovery, all manner of different recoveries from the current depressed levels of economic activity, you can look and see what the likely returns to gold are over the next couple of years, or indeed in the long term. And I'd encourage any of your listeners that are interested to go to our website, gold.org, and have a look at the valuation framework tool, Quorum, which is on our Gold Hub section. Generally speaking, using external forecasts, there certainly is the potential for gold to prosper over the next couple of years. And in the long term, depending on what inputs that you put in there, you will see that there should be a positive return for gold over the longer term as well. So just because the price has gone up a lot this year doesn't mean that there isn't more potential. After all, we're in unprecedented economic times, certainly in modern times. And these sorts of risk and uncertainty are very big factors in driving investment demand in gold.
Well, and that is what is ruling the roost right now. Let's see what happens if and when consumer demand comes back. But John, it was a pleasure talking to you today. Thank you so much for speaking to us at BloombergQuint.
Thank you very much. Thank you for your time. Bye-bye.
Yeah, bye-bye. Stay safe. And viewers, thanks for tuning into this. So I hope we were able to give you some answers or some perspective about gold, the rally, the factors behind it, and what the way ahead. Thanks for tuning in.